Hello, this is Andy Weissman. I'm very pleased that all of you are on the line for our presentation today. This is going to put on, as I think most of you are aware, the Energy Business Watch and WDT Technologies have a partnership and put out a series of publications together that look at the various energy markets. And we're very pleased today that we're going to put on a joint program where I'll be speaking to some of the market issues, and Steve Strum of Weather Decision Technologies will be presenting a weather forecast both for the remainder of the natural gas injection season and for this coming winter. And I'm actually particularly excited about what Steve has to say. I won't steal any of his thunder, but if we can switch to the first substantive slide, I'll just dive into the presentation, and I'm going to give a brief overview and then hand the baton over to Steve, who will go into his weather forecast in some depth, and then I'll come back after that's completed. I think okay. We're on the slide now that, just to try to set the context, shows what's been happening to various energy commodities since the beginning of the year. Let me pause just a second, but good. Okay, apologize. The slides are being removed remotely, and I apologize for that. But we're on the right slide right now, and as I think most of you are aware, that we've seen since the beginning of the year, we've actually seen some steep drops in oil prices, and natural gas prices started the year higher than they are now, fell fairly sharply, recovered, and then dropped again. Electricity prices actually have been particularly weak over the past since the beginning of the spring, and as you can see, though, what it may turn out to be fairly noteworthy is that all three commodities have started to trend upward again. And the bottom line for the presentation today is that we think that there is a substantial likelihood that will continue, particularly for natural gas and oil. We think basically the market has significantly over the past 3 or 4 months in particular, that the market has significantly mispriced those commodities, and we're going to explain that in some depth. If we can go to the next slide. Okay, for natural gas, 4 key takeaways. First of all, really, I've been looking at the natural gas market in depth for almost 17 years now, and it's been an interesting time because they're really both in natural gas and oil. There's been something of a disconnect, a fairly significant disconnect between the supply-demand fundamentals and where prices have been at. And we'll talk a little bit more about the reasons why that's occurring. But for natural gas in particular, that can only persist so long. The effect of prices being out of whack with the fundamentals is that we are not putting enough natural gas in storage, and the market will respond to that. Predicting the extent to which it will respond next week versus next month versus 2 or 3 months from now is more art than science, but the market will respond, and we think there's a very high probability, as indicated in point number 2, that there's a very high probability that prices will go up. But there are always, as all of you familiar with the natural gas market know, there are a number of uncertainties, and we've listed under point 3 the most significant of those. Significant of those. And what does that mean in terms of action? And point number 4, from a perspective of those of you on the call who are end users, and there's certainly a significant number of major electricity users and natural gas users who are on the call right now. We think that for both electricity and natural gas, it's very important to be focused on the issues that we're going to talk about in the presentation today, and that the message is really fairly clear that it's to the extent that positions, not just for 2017 but 2018, are not yet hedged. This may be a very important opportunity to hedge further. And from a producer standpoint, it's really a more difficult and challenging situation. We do think prices are definitely going to strengthen, and that in and of itself suggests waiting, and that it'll be possible to lock in higher prices as we go out in time. But it is difficult because there are a significant number of natural gas producers who subscribe to our publication, and it's harder to assess exactly when prices will firm up. And the trend among producers today, we think generally for good cause, is to want to hedge a significant portion of their production, and to do it before the next calendar year starts, and that kind of can create pressure to go ahead and lock in prices, even if the overall picture is that they're likely to strengthen further. And we'll go into that further during the course of the presentation. If we can go to the next slide. One of the other points we want to emphasize with respect to the natural gas market, a point one of my analysts raised with me a number of weeks ago, and it actually kind of startled me, even though I kind of knew it in the back of my mind, that if you look at the graph to the right, in the past roughly a year or so, we've actually had 4 times when in a very short period natural gas prices have moved upward by 50 cents per million BTU. And it's the number of sharp run-ups is really fairly striking, and there have been a couple of times when there have been major declines as well. So we're really seeing some pretty strong volatility. We've seen more than a 20-cent run-up just in the last, I think, 3 weeks or so. And it's possible that as the market adjusts and reprices to move prices to a level that makes more sense in terms of the fundamentals, we could see a pretty sharp upward price movement at almost any time. Not saying it's likely that we'll see a 50-cent cumulative 50-cent price move over the next few weeks. But the lesson of the past year is definitely very striking. If we can move to the next slide. And let's go past the placeholder. I'm going to try to wrap up the kind of my introduction pretty quickly, so we can turn to Steve's presentation. As those of you who attended our last webcast know, and we've been in a situation where for all this calendar year so far, one of the dominant factors that's affected the market is we had an extremely mild winter last winter, which minimized use of natural gas. If we can turn to the next slide as I'm still speaking, that resulted in a very high end of season storage. And at the same time, what's equally clear, with really very clear cut and sort of almost indisputable, is that since then the market and anything has definitely been undersupplied. And what we've been saying for some time, if you look at the graph on the right, is that because the market is undersupplied, that what we were likely to see is that the fairly large stored surplus that existed at the end of the winter, at the end of March, it was actually more than 400 BCF, would really decline throughout the injection season, and that eventually the stored surplus would be completely eliminated and turned into a deficit. And that's exactly what's happening. What is different this year is that usually the market responds fairly rapidly to the trend in the surplus or deficit versus the 5-year average. This year it's been much slower to respond, that really is what sets up not only the possibility but the likelihood of a fairly sharp price move upward, because in the end the market will move storage to a more appropriate level. Why? What's caused the market to be undersupplied? One, basically, we've seen very strong growth in demand, with the single strongest driver. If we could start switching to the next slide while I'm talking, the single strongest driver being the major increases that are occurring in exports, both pipeline exports to Mexico in particular, and LNG exports. And that's really part of an even larger phenomena shown on the left, that we're really still in an early stage of a period in which total demand for natural gas produced in the United States is started to increase very rapidly, and is actually going to increase even more rapidly during the remainder of the decade. So far, basically, supply has not been completely keeping up with that. If we look at the graph on the right, part of what creates some confusion, I think, in the way at least some analysts look at the market, and part of what may account for the fact that the natural gas is currently underpriced, is that this growth in demand for natural gas is being met by continued growth in production of natural gas from shale basins, and also some significant increases in production of associated gas. But it's important to remember that there are significant declines elsewhere. And if you look at it on a net basis, if demand were stagnant or even growing slowly, supply would be keeping up. But demand, basically, underlying demand prior to taking into account weather and changes in coal displacement, is increasing fairly significantly. If we can start to switch to the next slide, is changing pretty significantly, and will continue to change and will grow rapidly next year. With that kind of general context, let me turn it over to Steve. I'm really excited about the presentation that Steve is about to make. He has some really important insights, particularly about the frequency of extreme weather, extreme in the winters. But let me not steal any of his thunder. Instead, just ask Steve to jump in.
All right, thanks, Andrew. Let's see if I can get this going here. Okay, here we go. So we'll start off just looking at a general summary here of what we've seen so far this summer, and looking forward here through the balance of the year, and some key points that are kind of important to keep in the back of your mind. First of all, the summer thus far has been hotter than normal, and it is expected to stay hotter than normal as we head through the balance of July, August, into September. But obviously last year was an extraordinarily hot summer. In fact, it was the hottest on record since 1980 in terms of a population-weighted CDD basis. And so a very high benchmark compared to last year, so we're not going to meet that this year. And in fact, we also have had the 5 hottest summers on record since 1980, all within the last 7 years. And so what that has done is created a 5-year average and a 10-year average, looking at weather or CDDs, that is really, exceptionally high in terms of its shift from the long-term 30-year normals. And so we have these really high benchmarks to compare against. And so even though it's been a hot summer, compared to some of those recent years, it's just not quite there. So the summer thus far is ranked 8th hottest, but if you exclude those recent record summers, we would have been third hottest had the same summer happened 7 years ago. So again, it's a hot summer, but not as hot as what we've seen in some of these recent years. Now, also, we're just getting into the heart of the hurricane season, which we normally see the bulk of our tropical activity take place between August and the middle of October. And so we're just about to that point right now. And so that is going to be a factor going forward as well, whether we potentially see a impacting storm that would have an impact on Gulf production and so forth as we head into the heart of the hurricane season. And then the upcoming winter season, we're still forecasting to be warmer than normal for the country as a whole, but much cooler than the last 2 years. And there is more risk that it could be colder across the eastern U.S. than what we're currently showing. The main driver there is that we've seen some significant shifts in the ocean basins in the Indian Ocean and the Pacific versus the last couple of years that will make it very difficult to match the warmth that we've seen the last 2 years. So odds are high that will be cooler than the last 2 years. Whether or not the pattern evolves between now and October to the point to where it's going to be very favorable for a cold winter yet remains to be seen. But we are at least, we have seen a significant shift from what we saw the last 2 years. And so the odds do favor certainly less warmth than what we saw the last 2 winters. Now, the key thing here again is looking at what's happening in the oceans. That's what drives the overall weather patterns across the globe. And a couple of key areas is that we did have warmer than normal water across much of the tropical Pacific this year. Earlier on, we had sort of a borderline weak El Nino, and that's still sort of in place across the central tropical Pacific. But the eastern tropical Pacific has cooled off. It's back down to near normal for the most part. But we do still have that warm pool in the central tropical Pacific, which if that does persist, will be important for the winter, especially when coupled with what's happening in the Indian Ocean. Last year we had the reverse of that pattern. It was warmer in the eastern Indian Ocean, cooler in the western Indian Ocean. That kind of really tended to kind of anchor a lot of the tropical convection last year, kind of around Indonesia and that eastern Indian Ocean area. This year with the cooler water there, if that pattern sort of persists, and we have the warmer water farther east, we should see a shift in the tropical convection this upcoming winter versus what we saw last year. Everything should be farther east. That in turn will have an impact on shifting the main trough location from the northwestern U.S. more into the eastern part of North America this winter. Whether that translates into any kind of sustained cold is at this point pretty hard to say, that being only the middle of July. But the pattern is different from what it was last year, which is a key point to keep in mind going forward as we head into the winter season. At least things are not setting up to be a repeat of what we saw the last couple of winters. Now, comparing to the last 2 years, again, we had the record El Nino in 2015, a little bit of a weak La Nina pattern last year. Again, if you look at the Indian Ocean areas there, the eastern Indian Ocean, which is below normal now, was above normal, or at least near normal, the last 2 years. And so certainly that's been a sort of a dramatic change there. And that, again, could be an impactful thing going into this winter season when coupled with that warmer water sitting there east of Indonesia towards the international dateline. In terms of setting up a more favorable tropical convection pattern for possibly driving more cold later on this year. But again, it's only July. That likely the patterns will change between now and October. We'll have to monitor how that does evolve the next couple of months. Now, looking at the summer season thus far, compared to last year, the top row of maps here show what we have seen thus far this year and what we're expecting for the balance of the summer season. The bottom row there shows the same periods from 2016. So you can see, well, first of all, this year we did have a cooler than normal May across a lot of the eastern U.S. And so that did kind of set us back a little bit in terms of the CDDs for the first half of that May to September summer season. And so while we have been warmer than normal by about 48 CDDs through the middle of July, again, running behind those benchmarks from the 5- and 10-year average, again, which are shifted pretty high because of the recent hot summers, and again, below what we saw for the same time period last year. Now, looking forward for the balance of the summer season, again, we're forecasting to be warmer than normal across the entire country. So again, it's a hot summer. But when you look at the bottom there, what we saw during the same time period last year, it was extraordinarily hot across the eastern half of the country. So we're looking at potentially ending up 111 CDDs below what we saw last year for that same mid-July through September time period. Even though it's hotter than normal, that benchmark of last year, which was the hottest summer on record on a CDD basis, is going to be really hard to approach. Again, if you look at the entire May-September period or just June to August, especially June to August, we are actually looking to end up hotter than not just normal, but the 5- and 10-year average as well. But that, what we saw last year is sitting there as this kind of comparison benchmark that people have in their mind. And, we're not going to be anywhere near it just because we did have so much incredible intense heat, really from door to door in the summer, from the start of the summer through the end. It was very hot across the country, the entire length of the summer, very persistent heat. And this year, we're just not, unless we have some kind of extraordinarily record-shattering heat wave in the latter half of August, we're not going to come anywhere approaching that. And so, again, it's a hot summer, but just not similar to what we saw the last year. Now, looking at just August, we are forecasting again the heat, as it's been this year for the most part, to be confined mostly to the western U.S. in terms of the most persistent heat. The eastern half of the country likely variable, kind of going back and forth between periods of heat and periods of more cooler weather. The recent trends, though, show that we may have a little bit more heat than what this map is showing across the central U.S. We'll have to watch that. But again, either way, the eastern U.S. should end up way below what we saw last year, which was just incredibly hot from the Midwest to the East Coast. So certainly not a repeat of last August, the way it's shaping up right now across the big population areas of the eastern U.S. But we do have the hurricane season coming up as well. This plot here shows the frequency of tropical storms and hurricanes by day of the year. And again, that bulk of the activity happens between August 1st and the middle of October. We're just about to August, and so we are going to see a ramp up in activity. We have not seen a hurricane yet this year. We've seen 4 named storms. All have been very short-lived. All have been very weak. That is going to kind of boost our totals in terms of named storms this year, probably a little bit higher than what we're showing there of 12 to 15. But we haven't had a hurricane yet, and that's actually normal. We don't normally see our first hurricane of the year until the first week or so of August, and so we're pretty much right on pace with not having had one yet. But again, that should change in the next couple of weeks. We're kind of almost to the point now where things are favorable enough to really start getting hurricanes going. And so we likely will have that factor to kind of, to watch in the markets going forward. Just, you get to that time of year in mid-August where you almost always have a hurricane out there somewhere in the Atlantic Basin. And so that will become a factor going forward. Now, the thing is, there's not really any correlation between hurricanes and storms in terms of numbers and how many impact the production area or the U.S. in general. Even looking at various ENSO phases, there's really not much correlation there with landfalls. You can have years that have had 3 storms or 22, and there's not really a whole lot of difference in terms of how many actually hit the U.S. And so we likely will see at least 2, maybe 3 named storms threaten the U.S. coastline, probably 1 or 2 of those in the Gulf, along the Gulf Coast before the end of the hurricane season is over. And odds favor at least one of those being a hurricane in the Gulf, in the northern Gulf production area or nearby at some point during the hurricane season. Now, whether it's a major impacting storm is hard to say. We have not had a major hurricane impact the U.S. since 2005, so it's been 12 years. And we've never had a stretch that long before without a major hurricane hitting the U.S. So, so those sort of odds kind of favor that at some point we're going to get one here before long. Whether it's this year or next year, there's no way to know for sure. But that's certainly going to be a risk, obviously, the next couple of months going forward. Now, looking at the winter, which is kind of going to be the bigger impact going forward, looking since 1980, we've had this distinct trend where we've seen, the overall trend has been sort of up in terms of the average winter temperatures, but really it's been mostly all in the warm winters. If you look at this plot on the left-hand side here, I've kind of broken down the winter averages by ones that were colder than normal and ones that were warmer than normal. And you can see if you plot a trend line with the cold winters, there's been no trend at all. So the cold winters of the last decade are averaging almost identical to what they were 20, 30 years ago. So there's been no change in the intensity of the cold when it happens. But the intensity of the warm winters has gotten or has increased with time. And that's really a function of what's happened in the Pacific. We've seen a distinct trend of warming waters in the Pacific Basin as a whole. And when we have a warm pattern across the U.S., we have a flow of air off the Pacific, and that floods across the country. And so if if the Pacific is a couple degrees Fahrenheit warmer than it was 30 years ago, the air is going to be warmer as a result of that. And so that air coming across the U.S. is in turn going to be warmer as well. And what that has done is, if you look at the difference between your average cold winter and your average warm winter, just averaging all the cold winters per decade and all the warm winters per decade and finding that difference, we've seen almost a doubling of the difference between those over the last 4 decades here. And so now it's the case this decade that we've seen over 440 HGD differences between the cold winters and the warm winters, whereas back in the 80s, it was only around 250. So it's been a distinct increase in that year-to-year variability going forward. And in fact, if you look back to 81, 82% of the winters between 81 and 97 were within a standard deviation of normal, or that, that long-term trend line. But since then, only 45% have been within a standard deviation of normal. So basically, we're dramatically increasing the number of winters that are falling more than a standard deviation away from that trend. So we're kind of going from a normal distribution with winter temperatures to more of a bimodal one, to where the tendency is either have a cold winter or a very warm winter, and those ones that are kind of moderately warm or weakly warm don't tend to happen as often anymore. And so that's going to be very important going forward, especially if that trend continues. And again, it's really going to be tied to what happens in the Pacific. The plot there shows that the warm winter temperatures, which feature flow off the Pacific, very closely match the trend in Pacific water temperatures. And in fact, if you exclude the last two record warm winters, the trend lines are almost identical. So there's definitely a strong correlation in that regard. And so if we do see the Pacific water temperatures continue to trend warmer with time going forward, that likely will continue to increase the intensity of those warm winter seasons when they happen. Whereas when the Pacific flow is blocked by a strong western ridge, and we have persistent blocking, and we're still going to have widespread snow across Canada. It's still going to be dark in the winter up there. We're still going to build really intense Arctic air masses when we have blocking in place. And so when the cold comes down, the intensity of that cold isn't really any different from what it's been in the past. But when that flow comes off the Pacific, there's just more warmth there than there was 30, 40 years ago. And so that warmth, when it moves across the country, is just now much more intense than what it used to be a few decades ago. So that is having a major impact on that variability of the winter patterns. So wrapping up here with the actual forecasts and scenarios for the winter season, again, our forecast is on the left-hand side there. The overall pattern is going to be driven by what's happening in the Indian Ocean and the Western Pacific. Again, things have really changed a lot from the last couple of years, and that should generally force more tropical convection out there, which really is what tends to drive the winter patterns more than anything else. As you get into the end of the year, that tropical convection should be shifted farther east from what it was last year because of the cooler eastern Indian Ocean and the warmer central Pacific Ocean. And so that in turn should shift the primary trough location from the western U.S., where it was last year, more into the central eastern portions of North America this year. Whether it amplifies to the point where we see a lot of Arctic outbreaks, it's too early to tell at this point. But we should see more cold across the eastern U.S. when the cold develops, instead of all of it going into the Rockies and the Northwest like it did last winter. And so, again, we're at this point in time, we're still forecasting it to be a little bit warmer than normal, but much cooler than the last couple of years. And there's a little bit higher probability now that we'll see a trend towards sort of a colder winter scenario versus a warmer one, based on those trends in the Pacific Basin and in the Indian Ocean Basin. So we'll have to watch that the next few months, and that will, again, skew the forecast one way or another as we head into October and up towards the winter season. But certainly, odds favor something much cooler than last winter. Again, whether or not we're actually colder than normal into one of those colder regimes again this year is still a little bit too early to say for sure. But certainly, you can kind of get an idea there of the range in degree days we could see with these different scenarios. On the bottom there, again, the 5 and 10 and 30-year averages, the normal there kind of give you an idea of the baselines that kind of give you sort of the range that we typically see as well, at least in the last decade or so. So again, we'll have to watch this very closely the next few months. Certainly odds are favoring increased variability in the winters going forward as well. And this winter could potentially be one that kind of skews the colder direction again after the two record warm ones the last 2 years, but certainly something to watch very closely here the next few months as we approach the winter season. So that's all for the weather part, and I'll hand it back here to Andy, who can take us through the impacts that this may have on the gas markets going forward.
Steve, thanks very much. And actually, if we can stay on slide 23 for a moment, I would like to. Looks like we're not quite where we want to be in the slide deck right now. But if we can go back to slide 23, please, the one that Steve was just speaking to. Thank you. I listened to what Steve has just had to say and look at these maps, and it has some very striking implications that I want to emphasize. One ties back, if we can look at the map at the right for a second. One ties back to a point that we made at the outset and will continue to emphasize, which is essentially what seems to be going down, a significant part. It's not the only factor, but a significant part of what seems to be affecting pricing right now is that the market, to some substantial degree, after two consecutive very mild winters, and particularly after an extreme mild winter last winter, to some extent is just assuming we're going to have continued mild weather. And what the bottom line is that because of a number of factors, but particularly the very different conditions in the Pacific, that can't rule out, you never can rule out entirely this many months before the winter begins. You can pretty much never rule out anything in the range of theoretical outcomes. But because of the major difference in the Pacific right now, what the map on the right shows is that the odds of are having anything even remotely close to last winter, to the very mild weather of last winter, seem to be quite low. The kind of estimated probability that Stephen has given, because it is a subjective judgment to some degree at this time, is essentially 5%. That is 1 in 20 possibility that we'll have a winter as extreme as last winter. And that's very significant, because that's really the range of potential demand in the winter is very high. And to the extent that the market is pricing in something pretty close to last winter, the odds are 19 out of 20 that will turn out to be wrong. That the number of degree days and therefore demand will be significantly higher, and it's part of the reason why we think that the odds of prices increasing are really quite high. Now, where will it be in that range? That's obviously the $64,000 question, whatever the right metaphor would be. And let's go over the other three maps that Steve has presented. And what I want to ask you to focus on in particular is two things. One is the distribution of different weather anomalies, and second is the comparison, particularly to December to February degree days. Because if I had to focus on one time period for the winter, that's by far the most important. And if you look back at for just a moment at the column all the way to the right, December to February last year was 2246 degree days. Now let's go to the left now and look at what Steve has labeled as his forecast, which is his most likely scenario with a 45% probability. It might be tempting to look at that and say, basically, there's still a lot of warmer than normal weather distributed across the United States in that map at the top left. And the answer is there is, but look at where it is. An awful lot of it is in the west, and in areas that are either sparsely populated or fairly mild in the winter anyway, where we seldom see very high, where we really can't see very high space heating demand, or in portions of the Midwest where the generation is coal-based. And if you then look at the core Midwest states that have the highest space heating demand in the United States, Illinois, I happen to be from the Chicago area, and Ohio, Michigan, Minnesota, Missouri, those states. In Illinois, the penetration of use of natural gas for space heating is something like 97%. And it gets, as all of you who've been in Chicago in the winter know, it gets very cold and generates a lot of space heating demand. And similarly, we have high population concentration in the east, obviously. And so even though the map has a lot of warm anomalies on it in the forecast case, if you look at the degree day December to February is 25, 35. It's almost 300 degree days, and roughly, let's say 500 BCF of demand higher than last winter. And if you go further down to where Steve has the data on 5-year and 10-year average, it's pretty close to the 10-year average, and again, nothing like last winter. And there is, Steve gives if we look at the map in the second column, there is a 20% probability of a milder than normal weather, but winter, but and with warm anomalies on for the season as a whole, covering most of the country. But it's still not remotely, if you look at the numbers for degree days, it's still not remotely as warm as last winter, or even as the average of the last 5 warm winters. And then there is if we look at the third column, the one that says cold scenario, which Steve assigns a 25% probability. To me, what was striking when I looked at that was that the cold anomalies are potentially focused in the areas with the highest concentration of space heating demand. And so even though there are areas in the country, specifically out west, that are warmer than normal, that if you just looked at the colors on the map, might seem to balance out the cold anomalies in the Midwest. Is when you look at what that means in terms of degree days, if that particular forecast verifies, is we're talking about well above. We're talking about in December through February 2679 HDDs, which is well above normal and gets us up to 430 heating degree days higher than last winter, and very rough rule of thumb, let's say 650 to 700 to 750 BCF of additional demand. If you add together the forecast map with 45% and the cold scenario with 25%, what we're talking about is, very roughly, and again, as Steve emphasized, we're very early. We have to keep revisiting this forecast very frequently throughout the remainder of the year, but we're talking about potentially roughly a 70% probability of somewhere between a very close to normal winter and a colder than normal winter. And so if we've got a market that is priced much closer to the last winter with that extreme warmth, there's a huge disconnect, and that that disconnect says actually we need pretty high levels of natural gas in storage. And the graph we showed earlier indicates we're going to be talking about potentially, if prices stayed exactly where they were today, we're going to end the injection season with the amount of natural gas in storage potentially at a 10-year low. And so there is a big disconnect going on in the market right now. And I think you roll back the clock to the beginning of the year. I think there was a belief that we have enough new pipeline capacity coming on in the Midwest, I meant to say Marcellus Shale, that early enough on that we might see enough of a surge in production to handle that. But what's happened is that almost all the pipelines have been delayed, and the most significant rover, the completion date is now quite uncertain. Energy Transfer Partners, the operator, has run afoul of the FERC staff, and there is a potential for substantial further delays. And ETP finally acknowledged just in the last few days that there's no way they're going to meet their initially targeted in-service dates. And so we're talking about, it's not quite a train wreck scenario of the sort that we've had in some prior years, but we're talking about a pretty major disconnect between the most likely winter needs and the end of injection season storage. So if we can move forward now, and maybe we're going to distribute these slides to make them available to all of you. And I think maybe in terms of using the time we have left wisely, I think several of the next slides are relatively self-explanatory. And so in the interest of time, let's go to the slide that I think it's 33, but the one that gives a price forecast associated with each of the scenarios that we just reviewed. The I'll just pause to catch up. We're using a new system, and it looks like for the webcast, it looks like it's a little bit slow and moving from slide to slide. So what I've done here, if you look at the blue boxes, they correlate with the weather scenarios that we just reviewed. And you'll see the probabilities are 45% to 25% and the 20% correspond with the maps that we just reviewed. And I want to talk about the specific implications for prices and also help interpret, explain how these need to be interpreted. So let's look first at the most likely scenario. Again, we're talking about in that scenario, a total degree days for the winter season that's, in rough terms, pretty close to normal in that scenario. And when we in that scenario, we think that the market is basically never going to completely catch up with storage, and that will end the season, the winter season, with, let me back up a little bit and say, I think one of the main points I want to emphasize is that essentially what the market ought to be doing right now and is not doing is that it ought to be looking ahead to next winter and asking how much natural gas we have to put into storage now during the injection season in order so that in a likely winter scenario, we'll have enough to get through the winter. And what our model is showing, and we have a lot of confidence that the model gives a good handle on this, is that to put enough gas in storage between now and the end of the injection season and have prices high enough during the winter to maximize use of coal, reduce use of natural gas generation, and keep storage at least a reasonable level. The strip should in particular the strip between current front month August contract and next March, ought to average $3.74. And what it's averaging as of yesterday's close is $3.23. And so what that says to us is that the strip in the most likely scenario is underpriced by about 50 cents. But I want to help interpret that even further. What what our model is really saying is that if prices adjusted to correct level today or tomorrow, in other words, if they adjusted immediately, they should be 50 cents on average, 50 cents higher all the way from August through March. And clearly that's not going to happen. Indeed, there's some potential that the significant portion of that adjustment may not occur until much later in the year. The longer it takes to adjust, the higher prices will have to be in the back end in order to average 374 over the entire period between now and March. And so this basically says that in our most likely scenario is very bullish, because in the real world, where it will take time for prices to go from where they are now, which is significantly underpriced, to a more appropriate price level, we'll have to see even steeper price increases later on, and particularly next winter, in order to keep storage at the end of this coming winter at 1550 BCF. And we'll talk about that. That's really not high enough for what we think is going to occur during the balance of 2018, and it's going to put upward pressure. If we wound up at the end of the winter with 1550, we would expect further upward pressure on balance of 2018 prices, to some extent even 2019 prices in terms of where the forward curve is priced. And so we think we're talking about, in the most likely scenario, a pretty steep price increases being required to balance the market. And then if we switch all the way to the right to Steve's 20% warm scenario, not the one not the 5% scenario where it's as warm as next winter, but what he thinks realistically is, a good reference point in terms of a warm scenario that has some significant chance of occurring, about 20% chance of occurring. Even then, if you look at the price towards the bottom, we would we think we are likely to see at least a moderate further increase in prices, about a 5% increase in prices. And if we look at the box in the middle, what that's telling us is that there is a 1 in 4, there's about a 1 in 20 probability of an ultra warm winter, and there's about a 1 in 4 probability of something along the lines of Steve's cold scenario. And under that, we're talking about prices, the strip, which is currently at 323, the August through March strip, which is currently at 323, needing to average 425. In other words, $1 higher. And even in that scenario, the way we run the model, we're only going to get to 1450 end of winter storage. So, I wanted to go through these in particular. These are complex issues. They depend very much on the assumptions regarding each component of supply and each component of demand. We address those issues in depth in our energy market outlook. The energy market outlook takes the same approach I'm taking right now of integrating, and it's something we're proud of because it's really not done to the same depth by any of our competitors. We really integrate in a very tightly way. Steve's weather analysis, the kind of scenario analysis he's presented just now, because there is always going to be uncertainty about the weather and what that really means for price. And what this is showing is that we're in quite a bullish situation. If we can switch, again, just in the interest of time, the energy market outlook, any of you are interested, we'd be glad to give you a trial subscription, and we'll go into these issues in great depth in the reports that we write, and also we will distribute the slides to you, and especially during the next few days, we'll be glad to respond to whatever questions you may have, either of me or of Steve, regarding the slides we presented now. But I just want to hit the high points right now. Let's go to the slide that focuses on 2018. And what the story is going to tell, a lot is going to depend. Maybe we can pause on the slide that shows some of the pipeline additions. That what will actually happen in 2018 is that once we get into 2018, the outcome this coming winter and what actually happens at the end of 2018 in terms of that winter, and to some degree next summer, will obviously make a difference. Pipelines will make the timing of completion of the pipelines that are being built in the Northeast to expand takeaway capacity will clearly make a difference. I think the bias right now, particularly for Rover, is for significant further delays. What's happened with the Rover pipeline, which is the two largest additions that were expected, to come into service towards the end of this year were Rover and Nexus. And together they were more than 5 BCF a day of capacity. Nexus became just had very bad luck, basically. As those of you who follow the FERC process may be aware, essentially FERC somewhat unexpectedly suddenly lost its quorum in February, and FERC has been unable to take any major action ever since mid-February, when then Chairman Norman Bay resigned from the commission. And there have been new commissioners appointed, but they have the first two, Richard Powelson and Neil Chatterjee, have been reported out of committee in the Senate, but they've not yet been voted on. And realistically, there's some small chance that Mitch McConnell will be able to get the Senate to approve those first two nominations before the Senate recesses this summer. I'd say the odds of that have gone up a little bit, ironically, because of the healthcare legislation failing, because it means the Senate's still there and they won't be dealing with that issue in any major way. But I think the odds are still that the nominations won't be approved until sometime in the fall. Once they're approved, even these first two commissioners are going to commission hasn't done anything for already 5 months, and by then it might be 7, 8 months. It's going to take a while to work off the backlog. So, and with Nexus, Nexus was set to be approved back in February, and the commission just wasn't able to do all the paperwork for that pipeline, and so they're still waiting. And with Rover, it was approved in a last-minute flurry, but there's then been a major problem between Energy Transfer Partners and the FERC staff, which has really raised some major questions as to just how long it's going to take before that pipeline goes into service. So, that will have an effect. But even in a base case analysis that assumes that Rover does go into effect by very late this year or early next year, what our analysis shows, if we can go to the price slide for 2018, is that basically we're going to, if I can allude back to the slides I presented at the beginning, there's more LNG export capacity that's going to come on before the end of the year. While we're looking at a potentially weak global LNG market by 2019, the utilization rate in 2018 for the facilities that will be operating then should be reasonably high. There will be growth in production in the United States, but we don't think it will, in part because of the delays in the pipelines, we don't think it will keep up with the increases in demand. And we think it will turn out to be the case that in our most likely case, in the bar chart at the bottom of this slide, we see 2018 prices as in particular the April through December prices as potentially averaging more than $3.50, and as of yesterday's close, they were at $2.91. So we see there are a lot of moving pieces with the natural gas market. One has to constantly update one's analysis, but in terms of kind of a reasonable base case, we see 2018 as also being significantly underpriced. If we can switch to the electricity slides. The bottom line is that the likely we do expect some increase in electricity futures for both for the remainder of this year and for 2018 and 2019. We don't expect it to be quite as steep. There are, again, a lot of moving pieces. As all of you are aware, there have been a lot of coal retirements. Part of what's interesting is that notwithstanding the change in administrations and the halt to the Obama administration's Clean Power Plan, we're going to continue to see further coal retirements actually all the way out through 2030. Between 2011 and 2030, if you accumulate the retirements that actually have occurred and those that have been announced, we're talking about slightly more than 100,000 megawatts of coal-fired capacity going away. If you look at the right, there's actually quite a bit of combined cycle capacity that's already in progress. If we can go to the next slide. And in terms of an overall context, what we see is both bearish and bullish factors. We're seeing very little load growth and actually some load contraction in some regions of the country. It obviously tends to reduce upside price risks. Definitely seeing surging renewables, although part of what's actually happening now is that as renewables, wind and solar continue to be added, in some significant hours, the new wind or new solar is just displacing wind or solar that was added over the last 3 or 4 years. We're also seeing the new combined cycle units, the efficiency of combined cycles continues to improve. So that actually can, to some degree, adding new ultra efficient units can negatively affect, can exert downward pressure on prices. And then there are significant upside factors. At the bottom line, if we can switch to the next slide, before I jump into the oil portion, the bottom line is that we would expect potentially a $5 to $10, $5 potential exposure to further increases in electricity futures and we don't really see the market basically has taken we've had for various reasons the market we think has become electricity market has become quite complacent, and that's in the context where natural gas prices could rise sharply, that there's clearly some significant upside price risk and not a whole lot of downside potential. And so, we definitely see this as a time that for electricity users, it's important to look at hedging possibilities. If we can go to the oil slides, I'm going to try to wrap up very quickly. Again, we'll distribute the slides. I really apologize. Again, we're using a new system now to manage the webcast, and we weren't anticipating the delays in going from slide to slide. Bottom line, let me just try to talk to this quickly. It's to some extent, from an analyst standpoint, it's been a really quite fascinating time because the market both the natural gas and the oil market have not been pricing at all efficiently, we think. And the issues with respect to oil are very complex, and probably many of you are probably following all the debate about whether the OPEC Russian production cuts were steep enough. There actually is some possibility that we'll see a further OPEC production cut. Maybe conceivably, it's possible we'll get at least some indications that further production cuts are being considered seriously as early as next week, when there'd be a meeting of the market monitoring committee that's been formed after the production cut agreement last November. And I think an even greater likelihood that we'll see at least some production cuts before the fall begins. But even before you consider that, what I want to talk about are the larger trends. And if we can go to the slide that shows reductions in U.S. crude inventories. What happened is that the market hasn't believed that the OPEC production cuts were steep enough in order to reduce inventories. And there are lots of reasons for that, but a couple that are important to recognize are the seasonality of refinery utilization of crude oil, and the imprecision of the data EIA publishes every week in its weekly reports. And we really, one really should not have expected, for various reasons, one should not have expected a deep plunge in crude inventories until we got into the refinery, the peak refinery crude utilization period in the summer, but we're there now. And what we predicted going into the period that starts in April, when U.S. crude inventories start to decline, is that we'd actually see a decline of about, on average, 3.5 million barrels per week during the period between April and potentially the end of August, before taking into account any possible releases of oil from the strategic petroleum reserves. And that's actually what we've seen. And if you look at the graphs that are on this page, what they show, these were done, we finished them last night, so they don't reflect today's EIA report, which reported another crude inventory decline of, I believe, 4.7 million barrels. But if you look what's actually happened, there's been a pretty impressive decline in U.S. crude inventories, and that's quite important because it has, if anything, an outsized effect on the global market. But what also happened is that there's not really a good understanding of what EIA really reports every week, and of the limitations on the and how to interpret it, how to read EIA's weekly data on the oil market, and that includes both what EIA reports with respect to crude inventories and what it reports with respect to what's called implied demand for products like gasoline. And what actually happened that confused the oil market is that in June, there were a couple of EIA reports that, frankly, to us on their face, seemed to clearly be wrong. And that reflects all sorts of factors on the crude inventory numbers. Sometimes the numbers that are submitted that are just wrong. There are also major impacts from just one particular vessels reach port, and when they unload and what's reported. So it looked for a while as if crude inventories were not drawing in the way that was anticipated. And even more, the market treats what EIA calls as implied demand for gasoline and other products as if it were a measure of true utilization of the underlying products. And that's just wrong. And the market often gets confused by that, because all implied demand is reporting is how much oil has been sent out of refineries and other primary distribution facilities down the logistical supply chain. And there are many steps in that supply chain before you get to how much gasoline is actually put into your tank when you fill up. And those two are confused a great deal, and they're factors that are seasonal in nature that cause it to be the case that if you look only at the implied demand figure, sometimes it's going to be much lower than the actual end user utilization in light duty vehicles and trucks, and sometimes it's going to be much higher. And there's also a lot of imprecision in that data. And so the market just got confused. And I guess to try to wrap up and keep the presentation at least very close to the 1 hour that we promised we tried to adhere to, the cumulative patterns are getting to be quite clear cut right now in the U.S. And well, it really is a global market. And for interest of time, I'm not trying to go through the whole global picture. There's also a major tightening of the physical delivery markets globally. And in the U.S., if you look at the big picture in terms of of the declines in crude inventories and the large drops in gasoline inventories that have occurred. We've had a number of weeks now where consecutive weeks in which gasoline inventories have declined, and recently some very large declines. And the amount of gasoline in storage is well below year ago levels right now. And if you look at those factors in particular, and you look at the growth in U.S. exports of both crude oil and products, this is a market that at least for is likely to move up uh, significantly further between now and the end of the summer. And it's a market that by seasonally refinery utilization declines in the fall, and so it would not be surprising if you saw some softening of prices in the fall. But as we head into the winter and early next year, we could see further tightening. And so we have expected, and we're now seeing, that prices are strengthening more than a lot of analysts expected. So, let me just stop there. What we've tried to do in today's presentation is to kind of focus on the really high level points and try to give you a big picture view. There's a lot of specifics that are obviously critical, and those are, we develop our view from the bottom up based upon supply demand fundamentals and weather and consideration of all the other factors that affect how the futures market behave in terms of market sentiment and technical factors that drive the market. From time to time, we actually put on half-day programs because that's what it really takes to describe all those issues in depth. But they are all addressed in the slides, and we will make the slides available to everybody who's listening in now. And then for those of you who are interested in more in-depth analysis, we welcome you to look at the energy market outlook that does go into a fair amount of detail. And I also want to mention just briefly two of the other joint products that we have in the partnership that between EBW Analytics Group and Weather Decision Technologies. And one we call the Energy Flash Report, which is proving to be extremely popular. It comes out every morning. It gives a snapshot view of where we think the market is going. But it also, part of what it does that just we think is the way everybody will start looking at things in the future, but isn't readily available for most other sources now, is that we completely integrate weather and what that really means in terms of demand. Our starting point are Steve's forecasts, and we go out a little further in time than most of the other resources that are available. We have forecasts for the current storage week and the next 2 weeks after. So depending on where we are in the cycle, we go out as much as 3 weeks. And for each week, we provide not only the weather forecast in the form of kind of weather maps that are issued by other forecasters, and we can show you the verification if you'd like, but Steve does a terrific job, and is neck and neck to be the best in the industry in terms of the accuracy of his forecast. We then take that forecast and specifically translate it into degree days for each of the periods we look at. And this is the part that's very difficult to find in other sources, we specifically translate it into weather demand as of the up-to-date forecast that morning, and specifically indicate what that should mean in terms of changes in price. And so we think that's a particularly valuable publication. And we also present a storage forecast that goes 4 or 5 weeks out. We present other information regarding recent developments. So that's turning out to be a very popular product for us. And for those of you who not yet seen it or not yet subscribed, we certainly want to encourage you to look at that because we think it's very valuable. And we also have in-depth reports about the electricity market that are called the Energy Risk Report that, again, I think are very unusual, and they're succinct, and we think they're very valuable publications. So, I want to thank Steve for his participation, and I want to thank all of you who are on the phone for your patience in listening to this. We will make the slides available to you, and because there's so much to cover and we can only hit the high points during the webcast, we'll be glad, especially for the next week or so, to respond to any questions you might email to us. So thanks very much for attending the webcast. We'll continue to put on webcasts from time to time, and hope to have a dialogue with as many of you as possible. Take care, and thanks again for listening.